Hello and welcome to the Business Standard Morning Show. I'm Swapnil Joglekar. Let's take a look at the stories for the day. Former Ranbaxy promoters Malvinder Singh and Shivinder Singh were sent to jail for 6 months by the Supreme Court, which also ordered an audit of the Fortis IHH deal. This is not the first time the brothers have been in the news for the wrong reason. This latest development is one more chapter in the long drawn out story of their downfall. In today's segment, we offer a peek into the journey of the Singh brothers.
The Supreme Court on Thursday ordered a 6-month jail term for Malvinder Singh and Shivinder Singh in the Daiichi Fortis case. It also continued the stay on the IHH open offer, and there will be a forensic audit of the Fortis IHH deal. This is not the first time the brothers have been in the news for the wrong reasons. Today's segment takes you through the dizzying heights and the spectacular fall of the once mighty empire of the Singh family of Delhi that was the force behind marquee names such as Ranbaxy, Fortis and Religare. Yes, this is the crumbling of a once mighty business empire, but this is also a very sad epitaph for a once mighty and very proud family. Bhai Mohan Singh came from Rawalpindi during the partition and started small as a contractor in Amritsar. Down the line, he acquired a small pharmaceutical company run by a pair of brothers, Ranbir Singh and Gurbakh Singh. That is where the name Ranbaxy came from. Ranbaxy did well on the strength of its two best-known brands, Campos and Cifran. But it was Parvinder, Bhai Mohan's oldest son, who took over Ranbaxy and made it truly big. At a time Indian drug makers were looking inwards, Parvinder decided to take Ranbaxy into international markets. By the time he passed away in 1999, he left behind a global pharma major. I had the chance to meet Parvinder in the 1990s, as well as his second-in-command, D.S. Brad. They dreamed up the vision for Ranbaxy to become a research-based pharmaceutical multinational out of India. Brar, especially, repeated this so many times one can still hear the phrase in his voice, research-based pharmaceutical multinational out of India. I wrote a big story for a leading business magazine in 2001 that raised the prospect that Ranbaxy could indeed become India's first MNC. At that time, Malvinder was a rookie in the company. He must have been 27 or 28 and sitting in an open cubicle in Ranbaxy's headquarters in Nehru Place, one of the more crowded office areas in New Delhi. By the time Malvinder became the big boss at Ranbaxy in 2006, when he was 33, Ranbaxy had moved to a sprawling facility in Gurgaon, where it could host the likes of Bill Clinton. But what struck you when you visited the facility was that everyone referred to Malvinder as Malav. Only the security guard at the gate referred to him as Malav Saab. But Malav Saab, not Mr. Malvinder or Mr. Singh or the boss. Alongside, the brothers created Fortis from scratch. I happened to attend its inaugural press conference. It was a small affair at a small boutique hotel in central Delhi. That must have been Shivinder's first appearance in public. He was to helm Fortis. We watched in amazement as Fortis became one of the two largest hospital chains in India from zero, and Religare became a big financial services company. What happened afterwards is the stuff of corporate folklore with not a happy ending, but many morals and lessons. Malvinder and Shivinder squandered millions of dollars, probably billions. So what are the particulars of the case in which the latest orders have come? Former Ranbaxy promoter Malvinder and Shivinder Singh have been accused of concealing information about wrongdoings at Ranbaxy when they sold a majority stake in it to Daiichi Sankyo, a Japanese firm, in 2008. Trouble was already brewing when Dinesh Thakur, the well-known whistleblower, left Ranbaxy in 2005 and reported his findings to the US Federal Drug Administration, the FDA, in 2005. But it took a few years for the lid to blow off the can of worms. It was in 2013 that Tarkos information led to Ranbaxy pleading guilty to 7 felonies in a US court and pay $500 million in fines and settlements. In 2016, the Singapore tribunal awarded Daiichi 3,500 crore rupees in damages. In 2018, the Delhi High Court upheld the arbitration order directing the brothers to pay 3,500 crore rupees to Daiichi Sankyo for misleading the Japanese drug maker during the deal by withholding information. In 2018 again, Daiichi Sankyo approached the Indian Supreme Court with the allegation that the Singh brothers were diverting funds using a number of shell companies to avoid the payments. Daiichi had also approached the Apex Court to stop a deal between Fortis and Malaysia-based IHH Group. IHH was to acquire a 30% stake in Fortis for $1.1 billion and follow it up with an open offer for 26% stake. Though the deal was signed in August 2018, the SC delayed the open offer in December that year. But this too is only the tip of the proverbial iceberg. There are other cases against the Singh brothers. In October of 2019, Malvinder and Shivinder were arrested by the Economic Offences Wing of the Delhi Police for allegedly diverting money and causing losses to the tune of 2,397 crore rupees. In 2019, the Serious Frauds Investigation Office, or SFIO, was also probing their role in an alleged fund diversion at Fortis Healthcare. After its initial probe, the SFIO had said that it believed that the fraud could be to the tune of 2,000 crore rupees. The Securities and Exchange Board of India, or SEBI, and the SFIO suspected that the Singh brothers had diverted public money from Fortis Healthcare to Gurinder Singh Dhillon, the head of Radha Swami Satsang Vyas and other religious bodies. The Radha Swami Satsang Vyas says it has more than 4 million followers worldwide. Many call Dhillon a god in human form. Dhillon is a cousin of the Singh brothers' mother and a kind of father figure to them. But somewhere the finances of the Singh family and Dhillon began to intersperse. Not just Dhillon, but others from the commune as well got involved. Its members went on to occupy key positions in the Singh Empire. In 2015, the younger brother Shivinder briefly joined the satsang full-time. Let's talk about the brothers for a moment. They used to really gel. I have interviewed them together and watched them finish each other's sentences. They enjoyed dressing alike and looked quite similar, except that Shivinder, every once in a while, gave a mighty twirl to his moustache. From there, it has been a steep journey downwards, right down to the time when the two apparently came to blows in an office in Hanuman Road near Connaught Place. And now, it's a prison term staring them in the face. Yes, this is the story about the crumbling of a business empire, but is also a story about human beings who undid the good work of 3 generations and squandered a rich legacy.
The Draft Drugs, Medical Devices and Cosmetics Bill 2022, which seeks to replace a 1940 law, claims to set several things right in the pharma sector. It may also avert a Ranbaxy-like scandal. Meanwhile, another draft bill put out by the government this week seeks to address problems in the telecom sector. The draft Indian Telecommunications 2022 bill, which once framed into Act, may have far-reaching effects on OTT communication services like WhatsApp, spectrum allocations, and several other feeds. Let us find out how.
Telecom spectrum is similar to Atma. It's Ajar, it's Amar, as the Bhagavad Gita describes. It has no physical form, yet it is omnipresent. That's how the government imagines spectrum in the explanatory note to the draft Indian Telecommunication Bill 2022. The bill, which will regulate the sector once it becomes an act, seeks to replace the existing legal framework governing telecommunication in India, comprising the Indian Telegraph Act 1885, the Wireless Telegraphy Act 1933, and the Telegraph Wires Unlawful Possession Act 1950. The draft Indian Telecommunication Bill 2022 has, for the first time, laid down a clear statutory framework and regulations on assigning spectrum. It says spectrum should primarily be given through auction for specific functions related to the government and public interest like defense, transportation and research. The bill proposes assignment through the administrative process. To enable efficient use of spectrum, the center may also refarm or harmonize any frequency range assigned by auction or administrative process. The bill enables sharing, trading, leasing, surrender of spectrum assigned, and a process to return unutilized spectrum. To address the demand of telecom companies for a level playing field, the Telecom Department aims to bring in a landmark change by extending the definition of telecommunication services. It proposes to bring over-the-top or OTT communication services such as WhatsApp, Telegram and Signal, satellite-based communication services and Internet under the ambit of the bill. So, OTT communication services have to take a license now and be subjected to the same conditions governing telecom players in India, like quality of service and security rules, etc.
For the first time, they're talking about including OTT-based communication services as telecom services. This is the first. And this itself is sure to be contentious. Providers of OTT services, in theory, would need a license. I think it is also, some would say, long overdue recognition of the concerns of the telecom operators in the sense, if you see what's happened in the last several years, ARPU dilution is a big problem. Like revenue is not just flatlining, but there's just no growth. The only thing it achieves is to balance things out a little bit, level the playing field a little bit, and that's okay. Forcing them to take a license, that has a lot of implications because, for example, just one little thing, that voice calls are subject to, intercept. Something on WhatsApp, they claim end-to-end encryption. What happens there? Certain areas or topics that are under the jurisdiction of either state governments or the regulator and so on seem to be, at least it seems to, the language seems to suggest that it will be pulled back into a more central body, or in this case, it could be the DOT or something like that.
The government will also have the power to terminate spectrum allocations partly or in full if it determines that assigned spectrum has remained unutilized for insufficient reasons over a period of time. Likewise, the spectrum allocated to telecom companies that are undergoing insolvency and are unable to offer services, pay dues or comply with license conditions will be taken back by the government. The bill also seeks to simplify the framework for mergers, demergers, acquisitions or other forms of restructuring by only requiring intimation to the licensing authority, while relief, write-off or deferment of dues may be allowed in cases of payment default in extraordinary circumstances. Next, the draft bill tries to achieve through law a right-of way enforceable at the state and at the municipal corporation level. This legal framework is key to the rollout of 5G services. It lays down a framework in which a public entity that owns the land has to grant right-of-way permission expeditiously unless it gives a substantive ground for refusal. The existing regulatory framework, based on Right-of-Way Rules 2016, has had a limited impact in addressing bottlenecks in the rapid expansion of telecom infrastructure. The 60,000 crore rupee Universal Service Obligation Fund will be expanded into the Telecommunication Development Fund by adding further objectives of underserved urban areas, research and development, skill development, etc. To prevent cyber fraud, the bill provides that the identity of the person sending a message through telecom services shall be available to a user receiving it.
So the bill clearly says that we will put to rest the retrospective effect, which is detrimental to the operators. So I think from that perspective, the operators can be rest assured there aren't going to be any onerous clauses coming in from a retrospective effect. The government in one of the paragraphs has very clearly mentioned that any entity which is granted a license shall unequivocally identify the person to whom it provides service. And I think with OTT players, considering the fact that they will also latch on to a telecom operator, I think it's important for them to also do a little bit of verification from their side. And that's been the demand of the telcos also. And from a security perspective, if you look at the wordings of the current bill as it stands today, the government is really very keen to build up the infrastructure in this country. So, the government has, the bill has a separate section on the entire right of way. The government has also said that the government can actually bring in a regulation to say that wherever the right of way has been granted, either by the central government or through a public-private partnership or even by a private operator, The government can push that you put in a concealed pipe and you give open access to all the facility providers.
DOT has also not heeded the unanimous call from companies that the USO fund levy should be discontinued or suspended for a few years until the large unutilized surplus cash of around 60,000 crore is utilized. The bill also raises some concerns. Experts indicate that the centre cannot take coercive action against states or municipal corporations to impose right-of-way rules, as land is a state subject. More clarity is also required as to how the government plans to regulate OTT communication services under this bill. Analysts also worry that the bill will adversely impact the consultative role of the Telecom Regulatory Authority of India, weakening its position. It excludes the obligation of the government to consult TRAI on licensing issues. Overall, the bill places emphasis on the development of telecom infrastructure while covering new age services to keep up with the times. The proposed legal framework seeks to be future ready, provides certainty regarding spectrum management, and reserves the penalty of imprisonment or heavy fines only for a small set of critical offences.
Meanwhile, gold prices have been spiraling southwards after they peaked in March this year, as global central banks joined hands to raise interest rates to tame inflationary pressures. With the US Federal Reserve lifting its policy rate by 75 basis points for the third consecutive time, analysts believe that the yellow metal will also continue to face pressure in the near term. Here's a report.
In a bid to fight the 40-year high US inflation, the Federal Reserve hiked interest rates by 75 basis points on Wednesday. The decision, which was unanimous, took the target range for the benchmark federal funds rate from 3% to 3.25%, the highest level since before the 2008 financial crisis and up from near zero at the start of this year. After the third straight big rate hike, the hawkish US Fed signaled to reach 4.6% by 2023, until inflation retreated to 2% objective. As the US Fed signaled additional monetary tightening down the path, the 10-year US Treasury yields jumped to a 15-year high of 4.1%. US dollar index also raised to hit a fresh 20-year high of 111.4. Moreover, even though gold is regarded as a hedge against inflation, rate hikes usually raise the cost of owning bullion, which pays no interest. On MCX, prices of spot gold have fallen 8% from March peak to 49,491 rupees per 10 grams. Globally too, prices of spot gold have trimmed 18% to $1,664 per ounce from over $2,000 per ounce recorded in March. Analysts believe that the demand for a safe haven asset is shifting to bonds as yields climb to decade high. Going ahead, the pressure is likely to continue on the yellow metal until inflation peaks out.
COMEX gold prices fell to near a 2-year low and dollar surged to a record level after Federal Reserve's hawkish comment. The metal is on a cusp of sinking into the bear market. During the recessionary and high interest rate period, investors prefer stable return and invest in a bond. Haven demand has been shifted to a bond as yield surges to a decade high, and going ahead, looking at the Federal Reserve's commentary, the rate market remains on a higher side, which will discourage the demand for the gold. Gold will remain vulnerable to selling pressure if inflation does not continue to rise. In the near term, spot COMEX gold is having support around $1,650 an ounce, and breaking of the same will lead to escalations of selling, and we could see a level of 1600 and more, while on a resistance front, $1,732 an ounce will act as a near-term resistance. Back home, spot gold prices could find support somewhere around 14,500 per 10 gram ahead of the festive season. The weaker rupee and physical demand will continue to help the limiting the loss in the gold, while the weaker international gold prices to weigh on the domestic prices. In the short term, MCX gold remains on a bearish side as long as it trades below 52,500 per 10 gram.
Further, analysts also believe that though dollar appreciation would put pressure on gold prices globally, rupee's depreciation may spark interest in domestic gold.
Since the Fed chief has indicated that the terminal rate is likely to be 4.6%, more rate hikes can be expected this year and early next year. Under such a scenario, dollar index is likely to remain resilient. Gold prices and dollar value are inversely related. Since gold price is expressed in dollars, gold price can be expected to further soften since dollar is appreciating. The short-term outlook for gold is bearish. In India, rupee depreciation will impart some strength to gold, but this is likely to be short-lived. Investors may look at buying gold only after the dollar index shows signs of peaking out.
That said, according to the World Gold Council, an outright recessionary environment or stagflation could offset pressure from the yellow metal. Further, it also expects increased trading volumes amid a pickup in consumer demand to support the metal in the near term. As regards today, FII flows, rupee movement and crude oil prices will continue to guide domestic markets. Besides, investors will also closely track the UK and Eurozone's factory and services data.
Thanks to the internet, we get the factory and services data of the UK and Eurozone within seconds of their release. But have you ever noticed the difference between download and upload speeds? A simple speed test will tell you that the upload speed is usually lower than the download. Why is that? Let us find out.
Internet speed has two components, download and upload. They both are part of the data package, but data plans offered by most internet service providers refer to download speeds only. Let us find out why. The speed test global index released by Network Intelligence and Connectivity Insights provider Ookla showed that the global median download and upload speeds on mobile networks in August hovered at 30.79 Mbps and 8.62 Mbps respectively. India's median download and upload speeds in the same period stood at 13.52 Mbps and 3.28 Mbps respectively. The disparity between download and upload speeds extends to fixed broadband connections too. According to Ookla's Speed Test Global Index, the global median download and upload speeds on fixed broadband in August stood at 69.14 Mbps and 29.02 Mbps respectively. Surprisingly, the gap between the download and upload speeds in India is not as glaring. The download and upload speeds on fixed wireless broadband in India stood at 48.29 Mbps and 47.52 Mbps respectively. One of the factors responsible for the difference in download and upload speeds is the network interface. By design, most of the network interfaces support higher download speeds than uploads. Therefore, irrespective of the device you use for internet services, there is always a gap in the download and upload speeds. This is because download speed makes up the internet experience for most users. In any internet activity, downloading consumes much more data than the uploads. Upload establishes the connection to access web services and download is the after result. To access any service available on the web, you first send the query to the web. This process involves uploading information. For instance, you are opening the business standards website. You enter the domain name in the browser and press enter. At this stage, the internet uses upstream to establish a connection with the website host on the web. Once the connection is established, the host sends back data to show the website and its content on the user screen. This downstream of information is called download. From watching movies available on over-the-top platforms to scrolling pictures and videos posted on social media, the size of information downloaded is always on the higher side compared to uploads. Therefore, it is the download speeds that make up for the internet experience for most users. But this does not mean upload speeds are inconsequential, especially today. The new age web services such as internet calling, video conferencing, online gaming, cloud data storage, and remote access require healthy upload speeds to deliver an optimal experience. The lack of it results in a choppy video during video conferences, broken audio during internet calls, and slow picture uploads on Instagram, etc.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
According to the Ookla data for August, India stood 78th in the global list of overall median fixed broadband speed. It was a drop of 7 places, but it retained the 117th spot in global ranking for median mobile speed. That's all for today. Catch the next episode of the morning show on Monday. Bye-bye for now.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.